Let me share how to get rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. If someone is sitting in the shade today, it's because someone planted a tree a long time ago. Rule 1, never lose money. Rule 2, never forget Rule 1. It's no surprise that people constantly seek advice from Warren Buffett, one of the world's richest individuals. Who wouldn't want to know the secrets behind his success over a 70-year investment journey? One person who had the chance to study and understand Buffett's methodology is Mary Buffett. In her book, The 7 Secrets to Investing Like Warren Buffett, co-authored with Sean Saya, she reveals the most critical insights for building a successful portfolio. Why is developing new habits the first step to success? How do you invest within your circle of competence? Why do undervalued companies present significant opportunities? I understand that terms like saving and thrift might sound unappealing, especially in today's inflationary environment, where making ends meet feels increasingly difficult for some. However, building a savings mindset is essential. Without it, even earning $10,000 or $100,000 a month won't easily lead to wealth. Studies of lottery winners show that most return to their previous financial state because they never developed the habits needed to stay wealthy. This is a topic Buffett emphasizes, a habit that must be cultivated. I don't think saving here means hoarding cash in dollars. Buffett himself isn't fond of holding cash unless absolutely necessary. Investing in something that loses value over time isn't a logical approach. The key point is this: you need money to invest money. Saving may not come naturally to everyone, but it's one of the most crucial secrets to success. You need to make it a consistent and disciplined habit. But where do you start? Step 1. Set aside 10% of your income. Transfer this to a separate savings account or somewhere you can't easily access it. If saving 10% feels overwhelming, try the incremental savings technique. Week 1, save $20. Week 2, save $40. Week 3, save $60. And so on. It may not seem like much at first, but by the end of the year, you'll be saving $530 a month. These figures are just for illustration. Don't jump to the comments to criticize. You can adjust this approach to your income level. Whether it's your savings strategy or habits, the key is consistency. The way to achieve consistency is to start small. People often get carried away with ambitious goals and set massive targets, but when they can't meet these goals, it becomes discouraging and can kill a good habit entirely. However, once you establish consistency and see your savings grow incrementally, the habit becomes permanent. One of the most important aspects of saving, for me, is automating the process. Humans are inherently lazy, so setting up a system that automatically deducts a portion of your income each month, without relying on your willpower, is critical. Spending money is the easiest thing to do. Wealthy people save and grow their savings. Imagine this: for every dollar you spend, you get a quarter back. How many dollars would you want to spend? The answer is simple: as many as possible. This scenario is unlikely in real life, but a good investment isn't far from this hypothetical. Some investors speculate, but people like Warren Buffett have a methodology. They focus on 2 things. 1. Determining a company's true value. 2. Checking if the stock price aligns with that value. This is where value investing comes in. Buffett is a master of valuation. He learned the value investing technique from Benjamin Graham, who taught it for years at Columbia Business School. Many of you have likely heard of Graham's book, The Intelligent Investor. You probably don't have years to dedicate to studying investments, but that's okay. Let's look at the short version. By analyzing the market and reviewing the right data and reports, you can identify undervalued stocks. Simply put, you're looking for stocks where the company's value exceeds its market price. Let's revisit that hypothetical world where you get a quarter for every dollar. When you spot a mismatch between a company's value and its stock price, you've likely found a worthwhile investment opportunity. Of course, nothing is guaranteed in the stock market. That's what makes it exciting. The lack of guarantees is what allows for astronomical gains. Some describe the stock market as a capitalist system. I believe the opposite. If you know the rules of the game, it's one of the greatest opportunities available to the middle and lower income groups. The likes of Koch, Sabancı, Musk, or Bezos won't invite you to become a partner in their companies, but the stock market offers you that chance. However, if you chase tips from Telegram groups, that opportunity can quickly turn into a disaster. Back to the topic. Numerous studies on value investing show it's a robust strategy, far better than speculation or acting on gut feelings. That said, an undervalued company can become even more undervalued after you invest. This is where another of Buffett's strategies comes into play: patience. More often than not, a company's true value is eventually recognized, and your timely investment can yield significant returns. So, let's say you've set aside some money for value investing, but there are countless companies out there. Where do you begin? Ask yourself, what are your interests, This is a great starting point. Warren Buffett doesn't invest in businesses he's unfamiliar with. This means he invests in companies whose products, services, and operations he understands and whose value he can assess. Buffett often refers to this as his circle of competence. You can create your own by answering some basic questions about your interests and understanding of success. What industry do you work in? Which brands do you enjoy spending money on? Are you good at cooking? Do you have expertise in programming? Using these and similar questions, you can build a framework that answers 3 key questions. 1. What do I love doing? 2. What am I good at? 3. What do I spend money on? This exercise helps you identify industries or business types within your circle of competence. That's where you should start looking for companies to invest in. Buffett's strategy isn't just about identifying undervalued companies. He also looks for a margin of safety, which he calls an economic moat. None of us, including Buffett, can predict the future. What we do know is that markets will experience ups and downs. Some businesses have products or services that can withstand bull and bear markets and shifting cultural trends. This resilience is what an economic moat provides. Generic brands are often the best examples. Think of products like Coca-Cola, Pampers, or Gillette, brands so iconic that their names become synonymous with the product itself. These companies typically have strong economic moats, allowing them to weather challenges over time. Another key consideration: can a company charge a premium price and still retain customers? Companies that can do this tend to stay at the top for a long time. Examples include Nike, McDonald's, and Burger King. Another measure of an economic moat is whether a company has a low-cost production model. Can it remain profitable even if it lowers prices? Companies that achieve this can outcompete rivals by offering lower prices. Amazon is a prime example. However, economic moats don't last forever, especially in technology. A critical question to ask is the company's product or service too dependent on innovation to survive? For instance, the iPhone currently has a strong economic moat, but its popularity depends on Apple staying ahead of the competition. It's entirely possible that a new, more innovative product could render the iPhone obsolete overnight. Nokia is a classic example of this. Interestingly, despite the book's example suggesting Buffett might avoid investing in Apple, Berkshire Hathaway, Buffett's company, holds one of its largest stakes in Apple. This could mean Apple is an exception, or Buffett believes its economic moat will hold for a while longer, given the immense global brand perception of the iPhone and other Apple products. Now, let's move to the more technical side of value investing: determining a company's true value. The 5th secret to investing like Warren Buffett is understanding the language of business, which means learning to read financial statements. This is where many people give up, but if you want to make smart investments like Buffett, you can't postpone learning this. Let's cover the basics quickly and without too much detail. Suppose you've identified a company that seems like a good investment opportunity. Let's call it Jack's Tomato Paste Company. You'll want to review 3 key financial statements: the balance sheet, the income statement, and the cash flow statement. These are easily accessible with a simple Google search. Start with the balance sheet. This shows a company's true net worth, or equity. You calculate this by adding up all its assets and subtracting all liabilities, including debts. Focus on the debt-to-equity ratio. For example, let's say Jack's Tomato Paste Company has $1.3 million in equity and $500,000 in debt. That's a debt-to-equity ratio of 38%, which is pretty good. Many companies have ratios of 100% or worse. Next, look at the income statement, specifically net profit. The key metric here is return on equity, ROE. Suppose Jack's company had $1 million in equity in 2021 and reported a net profit of $520 million in 2022. That's an ROE of 52%, which is excellent. Anything above 15% is considered strong. If you don't want to do the calculations yourself, you can find these metrics on paid platforms or free sites like Halkyatarim or Isyatarim, though free platforms may not provide every metric directly. Finally, review the cash flow statement. This shows how a company uses its cash. Does it have enough cash for daily operations? Is it paying off its debts? Are shareholders receiving dividends? Ideally, you want to see consistent, positive cash flow each year. Occasionally, businesses may have negative cash flow due to major acquisitions or sales cycles, but overall, a history of positive cash flow is a good sign. Let's take a breather. Analyzing financial statements isn't easy, and I know most people might not make it this far, but as the saying goes, no pain, no gain. The key is knowing what to look for. Even if a company's financials look healthy and profitable, that alone doesn't tell you when to invest. This is where valuation becomes critical. A company might have a solid balance sheet but be overpriced. A Mercedes is a great car, but if you buy a $1 million Mercedes for $2 million, it's not a smart purchase. The goal is to buy a stock when it's undervalued and poised to rise. The key to this is the net-net method, a value investing technique developed by Buffett's mentor, Benjamin Graham, and the backbone of all value investing. The net-net method involves comparing two metrics. 1. The company's net current asset value, NCAV, sometimes called liquidation value. 2. The NCAV per share. Let's go back to Amit's tomato paste company. The balance sheet shows $700,000 in current assets and $650,000 in liabilities, meaning the NCAV is $50,000. Now, calculate the NCAV per share. If Amit's company has 20,000 outstanding shares, divide the $50,000 NCAV by 20,000, giving an NCAV per share of $2.50. The next question is, what's the current stock price of Amit's company? Are the shares trading below $2.50? If so, the company is undervalued, signaling a potential investment opportunity. Benjamin Graham believed the best opportunities come with a 33.3% margin of safety, meaning the stock's current price should be at least 1/3 less than the NCAV per share. For Amit's company, that would be around $1.60 per share, a great opportunity. Now, let's move to something simpler. Portfolio management. Managing your portfolio wisely and responsibly is crucial. Start by accepting a simple truth. No one is right all the time. That's why it's wise to leave room for error in a diversified portfolio. If you lose 50% on an investment, you need a 100% gain to break even. Buffett's portfolio includes many businesses, and as he says, diversification is protection against ignorance. Here are 5 key rules for portfolio management. 1. Plan your capital allocation. Decide how much money to invest initially and how much to set aside for future investments. This requires nerves of steel. In 1969, Buffett stepped away from investing for 4 years because he saw everything is overvalued. When the market crashed between 1971 and 1974, his capital was safe. 2. Don't put more than 10% in a single stock. Avoid putting all your eggs in one basket. If the basket falls, you won't lose everything. 3. Rank your investments by confidence. If you're interested in 20 companies, take time to rank them based on how confident you feel about each. The higher a company ranks, the more capital it deserves. This also helps you know what to do if a company's value drops. 4. Review your portfolio annually. Check your company's annual and quarterly reports. If you notice concerning trends, make adjustments. 5. Don't sell based solely on price. A good company is more than its stock price. Think of your investment like an employee. Would you fire someone just for having a bad day or week? Great companies can experience significant price drops. Buffett loves buying strong companies when their stock prices fall. These 7 secrets, free of specific investment recommendations, won't make you a multi-millionaire overnight, but they'll give you a strong foundation. The rest is up to you. The most critical secret is building good financial habits, like consistently setting aside money for investments each week or month. Other secrets revolve around value investing, finding and investing in undervalued companies. Buffett also uses his circle of competence to understand businesses better and invests in companies with economic moats to weather economic storms. Portfolio diversification is another key focus.